Okay, so in this video, what I want to do is begin our discussion of this last section of the material, and we're going to just draw upon what we've done earlier, especially in section 2. And this whole area, chapters 10, 11, and 12 are all interrelated. And because they're interrelated, they deal with bits and pieces of a puzzle. The bigger puzzle is called capital budgeting. And what we're doing in capital budgeting is we're trying to find out or trying to figure out whether or not a capital investment proposal is going to be economically viable. Is it going to add to the value of the company, or will it not? Will it deter from the value of the company? And so it's a process. Well, the first thing we need to do is, you think about it, any capital project, I'll have to pay money up front, right? Finance comes first. I have to pay for it. And then hopefully that investment, that capital that I'm buying, will generate cash flows to me, positive net cash flows to me after I buy it. Well, those don't come immediately. They're only going to come in time. And since I've got to account for the financing, I've got to pay for that. I've got to pay for the financing of that thing. And how do I finance? Well, I finance with, the securities we've already talked about. I finance with debt or bonds. I finance with preferred stock, and I finance with common stock. So what I need to do is I need to get some kind of discount rate to discount those cash flows back to the present in order to evaluate a capital project. All right, so what chapter 10 is about at least one process of coming up with a means of calculating that discount rate. And so that discount rate's called the weighted average cost of capital. Now, once again, I really hate this part of the phrase, cost of capital. The discount rate's not the cost of the capital itself. The cost of the capital is whatever the price I have to pay for that stuff. But it is the cost of the financing of the capital. And so, this is terminology that's used everywhere. I'm not going to veer off of that. And so you'll see this in textbooks everywhere. They'll just call it WACC, W-A-C-C, WACC. There we go. All right. So that's the number that we want to calculate. Well, so how do we calculate it? Well, there's a formula in the book, and let me just write it up, and then I'll go through and explain the bits and pieces. So the WACC is equal to the percentage of my company that's financed with debt times the before-tax cost of debt capital, or debt financing. Now think about this though. Debt financing, remember, interest expense is tax deductible. So I'm going to have to take the tax implication. And I don't really want the before-tax cost of debt financing. I really want the after-tax cost of debt financing. So I'm going to multiply that times 1 minus my marginal tax rate. And so that's what will feed into, once again, this is a weighted average. Well, how is it weighted? Well, it's weighted by the percentages of our company that we're financing in these different ways. And so we'll talk about how do we calculate those. And then I'll add in the weight on preferred stock, right? If I have preferred stock to issue, times the required rate of return on preferred stock. And then finally, the weight of equity or common stock financing times the required rate of return on common stock financing. All right, so that's so it's a weighted average in a way. If you think about it, your grade in this class is a weighted average. You know, certain things are worth so much. You know, the office visits, according to the syllabus, they were weighted 5% of your grade. Homework's weighted 10% of your grade, and so forth. So there are weights, there are percentages applied to each of those, and so that's what we're doing here. Is we're coming up with this weighted average cost of financing. Now, I think what I might best do here is let's just walk through, if you will, walk through a problem, and then we'll see what we end up with. So I'm going to erase this part. Well, let me leave this up, and so you can, if I don't know if I'll have enough room, but well, I better erase the whole thing. I hope you've written this down, and I'm going to erase it. All right, now let's suppose that I've got, that I do have all three. I have bonds. And let's suppose they're issued in $1,000 increments. And let's say I have 2,000 bonds issued, okay? And the coupon rate is 8%, and that the current price of each of these bonds is $1,148, and that they're 10-year bonds. Okay? All right, so now if I go into the bond calculator and I calculate, okay, with an annual coupon now of $80, price of $11.48 for a $1,000 phase, 10 years to maturity. If I enter that in, we'll get a yield to maturity that's equal to, just right at rounded off, 6%. Okay? All right, that 6% is my before tax cost of debt financing that would go into, that's going to be my KD in the WACC formula. Okay? All right, now let's suppose that my tax rate is 26%. Well, if that's the case, then my after-tax cost of debt is going to be 6% times 1 minus 0.26, and that's going to give me 4.44%. Okay? All right, so that's my after-tax cost of debt financing. In other words, I'm just multiplying the 6% times 1 minus my marginal tax rate. All right, now next, let's say we do have preferred stock. And I know that the dividend, annual dividend, is $14. And that the current price on the stock is $160 per share. And let's say there are 1,000 shares outstanding. Okay? All right, so remember now, the required return on preferred stock is the dividend divided by the price. So it's 14 divided by 160, and that's going to be 0.0875, or 8.75% would be the cost of the required return for preferred stock financing. All right, so that gives us the information on the bonds. Now notice that in terms of my bond, the total market value of the bonds outstanding, if this is the price and there's 2,000 of them, if I multiply that out, then the market value of my outstanding bonds is $2,296,000. And if I've got 1,000 shares of preferred stock outstanding at $160 a share, that's going to be $160,000 in market value. Now, I'm going to come back to this later because that's going to be important in determining the weights. But I'm running out of room, so if you'll bear with me, well, I'll try to get this in. Let's suppose for common stock that you know that the risk-free rate is 2%. And you know the market risk premium, that is Km minus the risk-free rate, you know it is 6%. Hence, you also know that the required return on the market portfolio is 8%. And finally, you know that the beta is 1.3. Then the required return on common stock would be the 2% plus the 6% times 1.3. And so that would give you 9.8%. Now let's say you also know that the common stock, let's say the common stock is selling for $75 a share, and there are 40,000 shares. Okay, so let's say you know that. Well, you multiply that out, then the total market value of the common stock is $3 million. All right? All right, so now I've got the required rate of return for the equity is 9.8%, required return on my preferred stocks 8.75%, and the required after-tax cost of debt financing is 4.44%. So I've got all that. Now the only thing I don't have the weights. But I'm going to get the weights over here. What I'm going to do is I'm going to add up the total market value of my outstanding financing. And then I'll calculate the weights from that. So let me erase everything here. You can go back and look at it. But I'm going to erase this and we'll see how to do that. All right, so I've got bonds, preferred stock, common stock. And I got the market value. Now, think about this. You always want to use market value, not book value. Book value is fine, but we're trying to make an economic decision. And, accountants will tell you, book value is not a market number. And we want market numbers in economics, not what we've written on the books. What's on the books could be way different than what's the market says. And here the market's king. All right, so now I have 2,296,000, 160,000, and then there was 3 million. So the total market value of the company is, just sum this up and you'll get $5,456,000. Okay? All right, so now what are the weights? Well, to get the weights, it's just this number divided by the total. To get this weight, it's this number divided by the total. To get this weight, it's this number divided by the total. So what you'd end up with is 0.42, 0.03, and 0.55. Now I rounded those off to the nearest tenth. So it's really pretty straightforward if you think about it. Okay, now, so I've got all my numbers now. I can calculate the weighted average cost of capital. So let me just write it up, and y'all can start going through this. So the WACC for, in my case here, is I'm just going to say 4.4% times the weight, right? Because this was already the after-tax cost of debt financing. In other words, I've already accounted for the tax, times 0.42 plus 8.75% times 0.03 plus, I'm going to come back down here, 9.8% times 0.55. So, at this point it's just arithmetic. So if I calculate all that out, I'll get a weighted average cost of capital of 7.5%. All right, so that's chapter 10. That's what they're asking you to do. Now, some caveats here with chapter 10 that we need to think about is, are all capital proposals of equal risk to the average risk of the firm as it stands today? And the answer is, well, not necessarily. And so if I just use this number all the time, I'm likely to reject low-risk projects that are really quite good and would really help the firm out. And I'm also going to be willing to accept very high-risk projects that I ought to reject because I'm using too low of a discount rate. So how do you account for that? Well, what most firms do is they'll categorize. That is, they'll try to lump their projects into either a low-risk category, average risk, or high risk. And they'll create a plus and minus around the weighted average cost of capital. And that could certainly work. Now, a couple of other problems, you're also assuming that you're going to finance anything with the same percentages that your company is financed now, that you're not going to change the capital structure of your company. Well, you might, depending on how big the project is. So those are some of the caveats involved with using the weighted average cost of capital. But this is the starting point for this chapter. So I hope this is helpful in looking at chapter 10 and beginning to go through those problems. I'll post it.